desert region remains home to some of the nation's weakest markets, and Tucson is part of that group. Welcome to Apartment Market Dynamics from MPF Research. I'm Jay Parsons with your Tucson update. A big chunk of the desert region is still waiting for some meaningful momentum to kick in. In Tucson, it couldn't come soon enough. Tucson ranks among the nation's weakest for most key metrics, including occupancy rate, annual rent growth, and average rent rate. Of course, it all starts with the local economy. In the first half of 2012, Tucson appeared to be on the right track with some solid job growth, and then job growth levels slipped. Only 3,500 jobs added annually through Q1 2013. That amounts to growth of just 1%, and it's way below the growth level seen earlier in the decade. On top of that, the job growth that is coming in appears to be disproportionately benefiting the single-family market over the apartment market. Home sales jumped 12% year over year, and they're now at the highest volume seen since 2007. Now, of course, a lot of that is investor activity. A lot of investors buying up homes with cash, distressed homes, all cash, and then putting them out in the rental market. But the apartment sector is also losing some of its top renters to home purchase, those who could afford it. Maybe they've had a desire to buy a home for a while and just now feeling comfortable enough to buy one now that it appears prices won't drop further. They're actually trending up a good bit. Now, we don't think this is a big factor in most markets across the country where there's good enough job growth to backfill units vacated to purchase, but it is a problem in some of these bubble-busted markets like Tucson. So home sales are picking up. Again, that's not unusual, but since we're not backfilling those units that are moving into purchase very quickly, occupancy is still in weak shape. Occupancy came in at just 91.1%. That's up 50 basis points for the quarter, but down a painful 160 basis points year over year. That is the worst occupancy drop here since 2009. And that rate of 91.1% is the second worst among the nation's core 100 markets, ahead of only Memphis and just a hair behind Mobile, Las Vegas, and Little Rock. And rents, no surprise, they're not growing. Year-over-year rent change was flat through Q1. Tucson hadn't been seeing much pop anyway prior to that, but now even the modest growth seen previously has disappeared. And let's look at year-over-year revenue change by the product age, and this is very telling. Weak numbers across the board, but they're especially terrible at the top end, units built in the 2000s and the 1990s. And this provides further evidence that the top-end apartments are losing folks to purchase, and the weak economy isn't allowing those units to backfill very quickly. Revenue change is a combination of the shifts in both occupancy and rents, and both are trending sharply negative in newer apartments. And unfortunately for Tucson, it doesn't appear that an economic recovery is right around the corner. Now, that does mean that, of course, that we're probably not going to sustain this big growth in home sale volumes. So that means that we're not going to see a continued huge loss of renters to home purchase. That's good, but it'll take more than that for the Tucson apartment market to muster up some decent momentum. We're expecting only modest improvement for the Tucson apartment sector over the next year. And that wraps us up for Tucson. So until next time, for Apartment Market Dynamics and MPF Research, I'm Jay Parsons. Thank you for watching.
Want more? Go deeper with NPF Research's apartment market reports. From a national level, down to individual metros, to specific neighborhoods, NPF Research has been providing unparalleled apartment market intelligence to the multifamily industry for almost 5 decades. Learn more by contacting us at 877-284-4938 or visit www.npfresearch.com and click on Market Reports.